From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for January 24th, 2025. Let's check the calendar. The Bucks are on the road through Sunday. And the Admirals are home tonight and Saturday with the Charlotte Checkers. And finally, St. Kate's Hotel is holding the 31st Poetry Marathon. So if it's Saturday at 10 o'clock in the morning, stop me if this sounds like it's too much fun. Okay, let's back up 1 week. We talked about the Planters Nutmobile crisscrossing America promoting nuts. Well, it's getting crowded on the highways with this addition. You can now drive a Chameleon coffee cup across the country. It pays $75,000 a year with full benefits. That's $30,000 more than the Planters gig. Maybe with a little luck, I could work myself up to the Wienermobile. Hey, Stop the Presses, a bid to free 5 elephants from a Colorado zoo has been rejected after the Colorado Supreme Court ruled that elephants are not people. Those elephants need better lawyers. And finally, a passenger clung to the outside of a high-speed German train traveling at 175 miles an hour. The doors shut him out while he's on a cigarette break. He hung on for 20 miles. More proof that smoking can kill you. On the podcast today, we have Adam Bailey, Joel Driesing, and wrapping up the week, here's Kyle Teddy.
I guess hanging on for 20 miles was better than the alternative choice. Not quite as rough of a week for markets as maybe that German train passenger. Nasdaq up 1.7% this week, closing at the bell at 19,954. The S&P 500 also up 1.7%, closing back near record highs Thursday and back above 6,000 for the first time since around Christmas. Closing at the bell at 6101, again up 1.7%. And the Dow Jones Industrial average closed the week up 2.2%, despite dropping 141 points on Friday, up for the week 936 points. Closing at the bell in New York at 44,424 for the year. Nasdaq up 3.3, the S&P up 3.8, and the Dow Jones Industrial average up 4.6. Adam, a good start to the year so far. Yeah, maybe a 4-day shortened week here with MLK to start the week, but an S&P back near record highs, the middle of earnings season here, and plenty on the kind of news agenda. What kinds of things are you looking at right now? What kinds of things are you hearing from clients?
Well, for one, I think it's been a rise on the fundamentals, stabilization in interest rates, and some pretty good earnings numbers coming out of corporate America. Like you said, we are in the meat of earnings season. Kind of started off with some of the banks last week, banks having some solid earnings, some technology companies having some solid earnings. Guidance remains pretty good. So if there's anything that you want to see leading the rally, it's some just long-term technical indicators, interest rates, and earnings. That's what's led us higher. I think for me, the story has been, the Dow seems like it's taken the baton so far this year. And we've talked about growth leading the charge the past couple of years, but you can't have that just year after year. At some point, other businesses besides the Magnificent Seven need to be picking up the baton from here. And Joel, I think you mentioned on the podcast last week, and I'll just kind of bring it back to this week, but 493 of the companies in the S&P 500 are expected to report their best quarter ever this.
No, I think it was like in 2.5 years.
Or 2.5 years,
like
okay.
That, yeah.
I wanted to make sure I got that right, but just some solid earnings numbers.
If you're a 2-year-old, that would be ever. So,
there you go.
It's all about perspective, I guess. Data from FactSet telling us that fourth quarter of 2024 is going to be the best quarter for S&P 500 earnings per share growth since Q4 2021. So we are, maybe if you're 2, then it's best quarter ever. But we are still talking about a pretty high rate of growth through the end of the year last year for earnings per share. And certainly as we look ahead for full year, better than 10% earnings growth forecast for this year. Another maybe 10 to 12, a little more looking into 2026. I think all these point to maybe some support for some of what we've seen in markets. I think the other piece I'm always interested in earnings season is that we get a lot of kind of outlook updates from CEOs, and we had seen a lot of sentiment surveys, a lot of kind of shift post-election towards maybe some CEOs that felt a little more optimistic about the direction we were headed, whether it was deregulation or the potential for deregulation, or whether it was maybe just a removal of uncertainty about who was going to be our new leader. And I think some of that now may make its way into some of what we hear, certainly from some of those tech companies, big announcements on some spend, as tech has been a massive hoarder of cash really for the last decade or so. We may finally be seeing some better uses for that cash than just sitting on their balance sheets, Adam.
Yeah, and Facebook is the one that's really announced a massive data center that they're going to be building. I saw an image of it, like the size and the scale of this thing superimposed over what is Manhattan Island, and it took up a massive amount of this, and we're talking tens of billions of dollars that they're expecting to spend. And we haven't really heard that from corporate America in the past several years. Businesses, not just technology businesses, but so many of them have been hoarding cash, for the lack of a better word, and they have used the cash in the past for share buybacks or paying dividends to the owners. Neither one of those things impacts economic growth in any way, shape, or form. But capital expenditures, building more factories or assembly lines or whatever it is, that does impact economic momentum. And now we're starting to see businesses willing to spend on capital expenditures, expand their operations, or whatever it might be. And that could go back and impact underlying GDP growth. Remember that business spending contributes to about 20% of our overall economy. 70% comes from consumer spending, but another big chunk, business spending, is about 20%.
And Adam, those sorts of expenditures are actually investments, and giving money back to shareholders or buying, some of the extra stock that's out there is a short-term sugar rush. But those long-term investments are really what helps long-term investors.
And, of course, no shortage of those buybacks as well. You've got companies like GE Aerospace talking about a $7 billion share buyback in their kind of latest announcement. But what I think is interesting is what the two of you point out is, that investment in property, plant, equipment leads to productivity gains down the road. It leads to the opportunity to kind of continue to build on that. But Adam, as a student of economics, it gives us one other piece, which is velocity, right? When money sits on balance sheets, it's not serving its highest purpose. It's maybe earning a little interest for the company that owns it. It's certainly given them some defense against uncertainty. But when it gets spent, now it's not just Meta spending $65 billion on a data center, but it's the construction company perhaps that they're giving it to who's going to turn around and pay workers who are going to turn around and buy a McDonald's cheeseburger or go to the movies. Yeah,
exactly. It's not just the velocity of money, which you're talking about. You're also talking about the money multiplier effect of when we put money into this system, whether it be capital expenditures. You got to hire somebody an architect to design the building. You got to have engineers engineer it. You got to have the construction crew build it. And they go out and they spend money and go on vacations and get trucks to get to the job site and so on and so forth. You have a turning over of each one of those dollars you spend on building property, plant, and equipment. It can find its way to other areas of the economy in a hurry.
And I think I'm very much looking forward to how much more of that we hear, certainly as Microsoft has been talking about data center build-out and as we've talked about some of the infrastructure necessary for that expansion. Those are all dollars that are going to make their way through, just as you talk about, to all those different sources. And Joel, normally we see a lot of that show up in the economic data, certainly far after the fact. Right now we're talking about what's going to happen. A lot of the economic data we look at talks about, okay, what has happened. Not a terribly busy week there, but in particular, one that really stood out for me was the existing home sales number, and not a terribly exciting year, 2024, and another one in what's been hurt by, higher interest rates.
Right. And the higher interest rates, and the big problem with housing is the lack of inventory. 2024 was the second year in a row that Americans sold the lowest number of houses since 1995. Think of how our population has grown. since 1995. So 2024 was the lowest. It was lower than 2023, and it was 4.06 million houses sold, existing houses sold. And that's down from 6.1 million as recently as 2021. And yeah, all sorts of things are stacked against those home sales, not only the interest rates, this week the average mortgage rate was 6.7%, down a little bit from last week when it was, the highest since May. But that's below where it was in 1995 when it was 7.9%. And it's just a little bit higher than the average since 1991. I'm sorry, the average since 1995, which was more like 5 or 6%. So you've got interest rates going against it. You've got that lack of inventory. And remember, after the whole housing crisis, when we had the Great Recession, a lot of builders just sort of said, this isn't worth it. We overbuilt, and now we're not going to do it anymore. And I remember talking with people who were contractors, and they just went into different lines of business. I have a cousin who was a contractor and went to work in a warehouse instead because it was steady business, actually a booming business, more recently, but it just wasn't worthwhile building houses. And so now we've got this big lack of houses, and that's adding to the expense of buying a house. We had record median price for houses last year, over $400,000 for a house, and it's going to keep going up. We're getting numbers next week from the S&P Case-Shiller house pricing index, and we're going to expect that to keep going up.
Yeah, and there's not really a good solution to the lack of inventory and for homes for sale, existing homes for sale. We talked about this a couple of weeks ago on the podcast, but out of all of the homes here in the United States, 40% do not have a mortgage left on the home. 4 out of 10, right? I mean, if you look at your block, 10 houses, 4 of them probably aren't going to have a mortgage left, and that's like the 55 and older crowd. So there's really not much incentive to sell if you no longer have a mortgage on it, if you don't have no other place to go. And on top of that, there's a lot of folks who have refinanced in the last 6, 7, 8 years at 2.5%, 3.5%, maybe 4%. And now the interest rates are higher. Are you going to sell to get a new place at a higher mortgage? And there's not much incentive to sell the existing homes. And to your point, we haven't been building them. And the ones that we have been building have been homes that are 3,000, 4,000 square feet and above. Not the 1,800 square foot house where the traditional first-time home buyer house. Builders have had a difficult time building those homes and being profitable.
Yeah, perhaps so that skilled labor has moved down to the floor below us and trying to build out this new space for Gruber. Those of you listening closely, maybe hearing some pounding in the background, we always apologize. We do control as much as we can, but apologize for any of that excess noise from some of that skilled labor. Joel, we got consumer confidence data, or the consumer sentiment survey, rather, at the end of the week. And, okay, things are still moving along okay there. Consumers still feel okay about where things are headed, but maybe not as good as they had been.
It went down for the first time in 6 months. And this was interesting because it's the only indicator that was really up, the only component within that index was people felt better for the 5th month in a row about their personal finances. So you think that's good, right? But there's more concern about inflation. And this was interesting. The number of people who were saying that they plan to make a big durable good purchase in the relative near future, that was 30% above where it was 6 months ago. And it's because people are afraid if they don't buy it soon, it's going to cost a lot more.
Yeah, and I think those are reasonable concerns, right? That maybe we should be spending more if it's going to get more expensive. Of course, the reality is that can become a self-fulfilling prophecy, right? You drive demand at a time in which supply can't catch up, and that very act of, okay, let's pre-fund some of those purchases, or let's pre-purchase some of those things maybe we didn't quite need just yet, can be the thing that leads to the higher prices down the road. That becomes that vicious circle of, okay, higher prices lead to higher prices. And so sometimes it takes a little bit more than just the Fed saying, hey, we're going to raise rates to disrupt that cycle. Adam, one of the things I have been spending a lot of time recently looking at is, how we're constructing portfolios. Certainly as we came through another great year for stocks in 2024, it became clear that a lot of portfolios had more stock exposure than what we had seen, not because we were adding to stocks, but simply because stocks had done so well that you started to see more allocation to that asset class that was performing better. And we, in many cases, saw it as an opportunity to pull back on risk, right? To sell some of that stock, to sell into those gains and move it back towards the bond side of the market. I often got the kind of question of, well, if you're doing that, is it because you see a lot of pain coming for stocks? Maybe things are a little expensive. So is it that the correction's going to come? We always talk about how difficult it is to predict, half or more of the downturns. And I think maybe there's a little more to why we're doing what we're doing than just simply because we think the pain is coming. And I know you've got some thoughts on maybe what the math looks like and why there might be some better opportunities in other places that speak more to the why you might want to pull back a little bit.
Yeah, I guess I'll speak first to the impetus of why I make changes in client accounts. And it's not necessarily a big picture macro view where we think the market's going to be up or down. It's based on the specific needs of each and every client and their own portfolio and their own desire for growth or risk reduction or a lack of volatility. And to your point directly, the stocks have run quite a long way in a short period of time the past 2 years. And if you haven't done much rebalancing, you have proportionately more in stocks today than you did a year or two ago. I'll say that differently. You have more risk today because you have more stocks than you did a year or two ago. And now I think it's a wonderful time to do some risk reduction changes, maybe sell some stocks, buy some bonds, take some risk off the table, bring the allocation and risk back to where it was maybe just a year ago. And with the market at all-time highs, I think there's just something harmonious about reducing risk at the highest prices ever. And I'll give some math and some context to this. The earnings yield on the S&P 500 contrasted against the yield on the 10-year Treasury. So by the way, the earnings yield, it is the inverse of the price to earnings multiple. You divide earnings into price to get current earnings yield, which is somewhere around, let's call it 4.5%, give or take. And that's the earnings yield on stocks. The 10-year Treasury on bonds is 4.6. The point is 4.6 is a bigger number than 4.5. That's all I'm saying, is that bonds are offering just a little bit more competitive yield and return than stocks have. And I think now is a good time to just do some of those rebalancing changes, not like going from all the stocks, all the bonds. I'm just saying on the margin, adding a little bit more towards bonds and towards cash, which are offering more competitive and compelling yields than they have in the past.
And don't be mistaken, this is not a suggestion that we don't have an opinion on where things are headed. It's a suggestion on the way we allocate portfolios is tailored to the individual, first and foremost, and it's tailored to where we see opportunity. And the opportunity in fixed income, and especially some of the safer areas of the bond market right now, looks far better relative to especially the U.S. stock market than it has in a very long time. The 30-year average yield on the 10-year Treasury is about 3.75%. So north of 4.5%, you're getting a pretty good deal relative to the last 30 years or so for bonds. And conversely, the 30-year average for yield on the S&P 500 is something like 5.8, 5.9, almost 6%. And so you're not getting the same deal buying stocks. And so I think when we look at history and say, well, stocks look expensive, bonds look maybe not cheap, but certainly a lot cheaper than they have in a very long time, well, I'd rather have more of the thing that's cheap. And again, maybe things are cheap for a reason. That can be especially true of individual stocks. I think when you're talking about broad asset classes, and especially broad asset classes that offer the safety that Treasury offers, or that high-quality bonds overall offer, I think you're talking about now a much different conversation in terms of how we choose to allocate portfolios.
Yeah, and I like to just use the information that the market is giving us to make some timely and practical and pragmatic changes in client accounts. Especially for people who are taking distributions in the distribution phase of life, maybe you got some RMDs. I love taking this year's and next year's distribution, maybe raising 2 years worth of expected cash withdrawals and taking it from stocks and setting aside in the money market, where you're still getting a competitive yield on cash, somewhere around 4-ish%, give or take, is what you can get on cash these days. And I haven't been able to tell people that for 20 years that you've gotten around 4% in cash. Last time was like 2004. And cash really hasn't been a big component of investors' accounts because you haven't gotten paid for it. But now that you are getting paid to hold a little bit of cash, I guess when the facts change, the strategy needs to change along with it. And it's okay to hold a little extra cash in your account for no other reason than you're finally getting paid to do it.
I'm ecstatic to have another tool in my toolbox, right? I'm ecstatic that the only thing that made any sense for 10 years was to buy stocks because interest rates were zero, cash wasn't paying you anything, bonds didn't have much to offer other than some downside protection, which certainly they offered that at times. And all of a sudden, now all these tools start to make sense again. And so I think for investors, you're in a much better place knowing that there are more pieces that you can count on. You don't just have to take risk anymore. As always, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.